SEGRO PLC has rejected a sweetened £13.5 billion takeover approach from Prologis, its third proposal since late June. The bottleneck is not the money on the table, it is which side's valuation of SEGRO's own portfolio the market should believe. Prologis is offering 0.0890 of its own shares, plus a partial cash option worth up to £2.7 billion, pricing SEGRO at 993 pence a share. That is a 33.8% premium to SEGRO's undisturbed share price before the approaches began, yet the board still says it undervalues the business. SEGRO shares slipped just 1.7% to 882 pence on the news, a muted reaction given the size of the premium being walked away from. If the market genuinely believed the deal was dead, the stock should have fallen back toward its pre-approach level, not hovered near the offer price. That gap between the rejected offer and the muted share reaction is the first open question. Chapter 2 examines the two sides making the case, in their own numbers.
Prologis argues SEGRO's standalone plan depends on flawless execution of a long-dated, largely unzoned development pipeline and an unjustified valuation. SEGRO's chairman counters that Prologis is trying to acquire the company cheaply, while its share price was dislocated by the Middle East conflict. Prologis points out SEGRO's reported net asset value fell 2.2% in the first half of 2026, questioning why the board's defense valuation still adds a premium on top. SEGRO's own board maintains the company is worth more than £13 a share, above even the Sweetened offer. The analyst split makes the disagreement concrete rather than rhetorical. Jeffries says the revised offer increases pressure on SEGRO's board to engage, while Stifel argues SEGRO's management is well able to realize the value inherent in its own portfolio without a sale. The buried assumption is that SEGRO's long-dated pipeline is the swing factor either way. Prologis treats it as unpriced execution risk dragging the shares down. SEGRO treats the same pipeline as embedded value the market has not yet recognized. Neither side disputes the pipeline's existence, only what it is worth.
UK takeover rules force a resolution regardless of who is right. Prologis has until 5 p.m. on Wednesday, the 22nd of July, to announce a firm intention to bid or step back for at least 6 months. If Prologis walks away, SEGRO shares lose the takeover premium entirely, since the current price sits well above where SEGRO traded before the approaches began in June. That is the state that would mark this as a trap for anyone who bought on deal completion hopes. Conversely, a raised offer above roughly 1,110 pence, the level analysts at Stifel flagged as a plausible landing zone, would validate the board's holdout and confirm the entry setup rather than the trap. Either outcome resolves inside 48 hours of this rejection. For holders, the decision is whether to stay through that deadline or trim ahead of it. For watchers, the single trigger to check is the takeover panel filing itself. A firm offer above 1,110 pence sharpens gantry case. A walk away or unchanged terms confirms the trap